Okay, good afternoon, everybody. Brian Shannon here from AlphaTrends.net. It's Friday, the 23rd of July, 2010, and the market has just closed. We had another positive session here today. The S&P 500, the SPY gained 95 cents or 0.87%, and it was a bullish week. It was a choppy week, but it was bullish, as we see on the weekly time frame now. That let's just kind of zoom in on this a little bit so we can get a little bit better look at the action. We have another week of gains in here. However, on the weekly time frame, we do still have a pattern of lower highs and lower lows. So what we're going to see is that this level, the 113, is really the big level. The next big level ahead for the spiders. I should say we have one other level as well. I guess that is going to take on some significance probably next week, and that's the 200-day moving average right here, and that's at about 111.60. But today we had a break past the short-term resistance we've been seeing developing at that 110.15 level, and the market closed above it. So I'd seen that some people were talking about, as the market did break, they're saying, well, there's no volume. And a lot of times what happens is you have that initial reluctance to buy from participants. That is, they look at it and they say, well, it's light volume, and they become hesitant to buy. But then the volume tends to follow after the fact as they realize, hey, maybe that market's going for real. And anyways, the point is to look at the price action and base your actions on price action, first and foremost, and use the low volume as a reason to say, okay, well, it's on light volume, but that's not going to stop me from participating in what appears to be a breakout. Instead, I'm going to keep my stops tight and maybe smaller share size and add to it as your confidence grows with more volume coming into the market. But a lot of people are slow to catch a breakout because they're waiting for that volume, and that's the incorrect way to do it. Only price pays, and that's what stops are for. Is that if it failed to hold, well, then you have to move to the sidelines. So as I just seen Joe Fahmy, who's got his show Sunday nights, had just pointed out, he thinks that the market's showing signs of getting healthier, and I agree with that. That we broke the downtrend line, we got above this high right here, so we had a higher high this week, and we have this important higher low. We have the low near about that 101 and a half area, but then this week we had seen a nice shakeout to that higher, what's now the important higher low on the daily time frame. Now, it doesn't mean the market will surge from here or we're out of the woods yet, because you look at the weekly time frame, and again, we're still below that 113 level, and we've got this market. It's still, the weekly time frame is still in a downtrend, lower highs and lower lows. So we still can't look at it and say, hey, there's all this bullish action. But when you look at the way, this past week was the heaviest week in terms of volume, not volume, but earnings reports. And if you look at the reaction of some of the bigger ones, let's look at it. For instance, Amazon today. Amazon reported earnings. It gapped way down and recovered completely in here. So the stock, a lot of people threw their stock away in Amazon. Let's just take a look at the intraday action. We'll take a look at the 1 minute, and you can see that right from the open, the stock was above that volume weighted average price, and it maintained above that rising volume weighted price all day long in here. So just a nice recovery in shares of Amazon. We also saw a big company, CMG, report earnings. CMG has been looking like it wanted to break down here recently, and here's the danger of being short in front of earnings, particularly one of these big market leaders. But when we look at CMG, what you'll see here is what happened is the stock gapped up, it pulled back a little bit and consolidated near that volume weighted average price, and then just exploded higher from there. So there was a good trading opportunity there. If you missed it, if you were looking at CMG and you missed the gap higher, then what you want to do is the right thing to do is don't chase that initial strength. Let other people do that, because those are the riskier buys. Instead, let it pull back, consolidate, get back above that volume weighted average price. And at this point, had you bought it there, your stop should have gone below, not the low of the day, but below this higher low, the pullback low. So and we saw another nice tight little consolidation in here as well. So and that stock finished right up near its highs on the day. This week we also had seen ISRG report earnings, and I remember that what was this, Thursday or Wednesday after the close, they had reported it, and I was talking about how the stock was down at 297 and how it was in the after hours trading, and it traded quite a few shares down there as well. Now the next day it didn't open nearly as bad. It opened down at about 308, and today really push those, squeeze those shorts. So we're seeing a lot of these stocks really have good action, and these are big market leading stocks that are having this good action on earnings. Baidu reported a few days ago. At first it kind of stuttered a little bit, I guess you could say. Let's just pull up the intraday on Baidu. But Baidu kind of stuttered here the last 3 days and had a couple sharp down moves, but it remained above the volume weighted average price since the event. So the event was 3 days ago, and this was basically the 3-day volume weighted average price. Today it got above that. It took out a little bit of resistance, and now you see on the daily time frame, this is as high as the stock has ever closed, I believe. Let's see, this high was, or this close rather, was 78.21. So there's one day the stock has closed higher than this, it looks like. And these are the big market leading stocks. These are the stocks that institutions go put big money in to get exposure to the market. And it's showing us that despite what you see in terms of volume on the S&P 500, the leading stocks are getting big action in here to the upside, and that's not volume that comes in from 100 shares at a time or 500 shares at a time from retail traders. So when we look at the SPY, we want to go forward with caution, still always with caution, because again, this weekly time frame is still damaged, but the daily time frame, we have a very important higher low from a to me longer term. I'd say that it should hold probably here for the next couple months if this market's going to remain bullish. We had the unusual uncertainty that the Fed had spoken about, and a lot of people were calling this a head and shoulders pattern, and we observed that wait a minute, what if we have an inverted head and shoulders pattern? Let's not be so quick to jump to conclusions there. But we've broken that neckline, and you could say the height of this pattern is basically from about, let's just call it 102 to be conservative, up to about 112. It breaks out at 110. That will give us an upward objective of 120. Now, I'm not looking for this market to go to 120, but it's a possibility we can consider. Of course, the first level of potential resistance is going to be that 200-day moving average. That often becomes a battleground, and just above that we have the 113 and change. But it looks like it's heading up towards those two levels, barring any unforeseen, more unusual uncertainties, I guess. The NASDAQ, for its part, also broke its trend line. This has been a little bit more stubborn with that trend line, but it did break that trend line. It's closed above this 50-day moving average a couple days in a row now. And it's interesting, again, to note that this so-called death cross, what a bunch of nonsense it is. It's not necessarily nonsense, but the day that it crossed below was Wednesday on the closing basis. The first day it closed below the 50, below the 200. The market closed at 44.60, 44.62ish. Today we're up at 44.60. This is just 2 days later. So after this so-called death cross, we have the market, up. What is this? Point and a half. So we've got a nice little percentage move. And in the SPY, we had seen that the death cross occurred down here when the SPY was at about 103, and here we are 7 points higher than that, 6.5% or so. So never mind all that. I mean, it's good to be aware. I always kind of go on about this. It's good to be aware of the volume. It's good to be aware of the moving average crossovers. It's good to be aware of where these moving averages are, but they're not really designed to be trading systems. Some people use them as a trading system, but moving averages lag, moving average crossovers lag. And what does it mean on a weekly time frame when the 10-week crosses the 40-week? It means there's indecision in this market on a larger term picture after we've seen this this big rally, and now the pullback that found support at the 38.2% retracement. Then we get this big volatility, and volatility peaks, it tends to peak at turning points. So perhaps we're seeing that this market has kind of found that turning point, and we head higher from here. The breadth was good again today. We had 2,400 advancing stocks, 600 decliners. So there are good signs in this market. The Russell 2000, it also broke its downtrend line, got above that 50-day moving average on a closing basis for the first time since right here on this day, since about May 13th. So, the 50-day moving average is still declining, which tells me that if we get rallies up to these levels, such as 113 on the SPY or 68 on the Russell 2000, that then maybe we do some sideways activity and the market will heal that way. But for now, the intermediate term trends are that we're back above a rising 5-day moving average. We're showing higher highs and higher lows. We had this, what was looking like a bigger correction maybe going to occur earlier in the week. We had the volatility near there, and the buyers came out on top. After that battle in that zone, the buyers walked away with the flag, and they've planted it firmly in the rears of the bears, and that's basically what's happening here. We have a higher high above the 50-day moving average, and we have this higher low down near 60. Now that's a long ways off. It's 8% or so away right now, but it does mark a higher low with a higher high on the daily time frame. It's not something I would suggest you put a stop way down below there if you got long this week, but that's the way some people choose to engage the market, and if that's the way you engage it, then that's what you have to understand. But what's more important than which high or low you choose to set your stop under is just being able to recognize the market structure as it unfolds, and to have an open mind to say that, hey, you know what, things do change in the market. We've been in this downtrend, but now we have a higher low and a higher high, and perhaps we're beginning a healthier turn higher. The semiconductors, since the Intel report, have really held on pretty well. If you look at it, let's take a look at a 10-minute time frame, and we can see that what's the average price. We'll take a volume weighted average price line. So this is the day that Intel reported and gapped up. Well, the average price in the SMH since that report is right here at that $28 level, and all I did was take this volume weighted average price line, and you can see I'm just controlling how far over it goes, but it's taking the average, and it says the average price since this day right here is $28 a share. So that means that anyone who bought semiconductors in general after the Intel report is in a winning position, and anyone who shorted on that is now in a losing position. So the semiconductors do act strong here. They cleared yesterday this 28.25 area. We tested that a little bit this morning, and the market got back above and held above it. So we're going to see that 28 next week is the important level to watch for support, I think, in the semiconductors. 29 is the bigger level of resistance. We've been up there 3 times. It's held as support, or as resistance rather, and that's becoming the basis of what we were looking at earlier in the week, which is this potential inverted head and shoulders pattern. If we can get above this 29 level, the height of this pattern is 3 points. It would indicate $32 a share. The weekly time frame on the semiconductors, hey, maybe, why not? I mean, maybe we head up towards $32 a share. Obviously, there's going to be other obstacles in the way, such as these highs near 30.5, but the semiconductors do act much better, and the financials as well. The financials, you can look at it and say, well, this trend line hasn't been broken, but we did close above for the second well, right, for the fourth time in the last 8 days above that 50-day moving average, and the 50-day moving average is still declining. And I don't think from a longer term participant standpoint, and when I say longer term, I mean anyone who's looking to hold maybe for several months. I think it makes sense that above 15 is where the momentum would come in on this. If you remember a couple weeks ago, what we were talking about in here was we were talking about this support in here at $13.60, that a lot of people were saying that was it. That's death for the financials below that level. And I was saying at that time, be careful that it might be a trap. And if it gets back above there, then we're going to want to look at other scenarios. And the other scenario right now is that we have an inverted head and shoulders pattern building here. 15 is the level where it officially breaks back above that. But when we look at the short to intermediate term time frames, we see that the buyers, we had this downtrend over here, the stage 4 decline. We had stage 1 accumulation, stage 2 markup, 3 distribution, 4 decline, stage 1 accumulation, then a kind of a false start, and now we're in this stage 2 uptrend with these higher highs and higher lows. I think 1425-ish area will be important for the financials next week. That's where we have this higher low, and that's approximately the location of that rising 5-day moving average. So that's where we are in these markets overall. Gold was down another 77 cents, but it's still kind of stuck here. Seems like gold to me is headed for, again, either that trend line, and it's pretty much almost at that trend line. More likely, I think, probably the 200-day moving average down near about $112. So the Russell, I keep calling it the Russell, but the retail holders, as I said on Wednesday, looked like the worst is probably behind for them. It's not necessarily that I would trade them, although they do look capable of maybe bouncing up towards that 50-day moving average. And if if you don't mind trading against what we still have is a declining market here, then if you don't mind trading just on these shorter term time frames, then we've got a constructive pattern in here, and we could also call this a little inverted head and shoulders pattern. So a lot of good signs coming out of the market this week, and in particular, I think it was good. It sucked to trade through it these couple of days where we had this, we had that what was looking like, well, maybe we were gonna start to recover, gap down, and then a smash, and then a gap up. That kind of action frustrates everyone except for the really minute by minute day trader, which I do some of those trades. Those aren't my preferred trades, but that which doesn't kill the market in here with all this volatility only makes it stronger. This really tests the resolve a lot of people, and really gets a lot of emotion in the market. And when the emotion has been kind of wrung out of the market in the short term like that, the group that comes away with that flag, that is the victorious for that movement, will often be able to continue to progress in the direction of that emerging trend. So that's going to wrap it up for me. It looks like we've got a couple questions here, and actually these are just all retweets. I appreciate that. Thanks, Mish. Market Minute gave me a Friday follow, I guess, follow Friday, and she's a good one to follow as well. Derek, thank you. Derek does a great job with all his posts, obviously. And Eldridge, thank you as well. Finance Trends, thanks for the retweet or the shout out there. And JDub929 has the one question here, which is, can I read into the fact that the VIX didn't breach the 713 low even as the SPX got below the 713 low? You can read into it whatever you want. That's up to you. I don't personally look at the VIX. I've never found the VIX to be very helpful. To me, I think that the VIX is the single most misunderstood, misanalyzed, overrated tool there is out there. I've found very few people that use it effectively to make money. It's good for maybe just general idea of what the market sentiment is, but as a money making tool, it's not something that's helped me personally. I'm not saying that I think it's useless, but I don't think it's something that I'm qualified to talk about, because I just I don't find it particularly useful. Okay, so we will do one more for Enrique, who wants me to take a look at EWW, which is the Mexican ETF. And Mexico, on a weekly time frame, it's kind of looking more neutral than anything on a weekly time frame. On a daily time frame, we've got this downtrend line here, we've got this uptrend line here, creating this big symmetrical triangle. And the theory behind a symmetrical triangle is that whichever way it breaks out, that it will continue in that direction. So for now, I think that it just really looks a lot more neutral than anything, Enrique. It's just kind of crossing back and forth above and below these moving averages. It seems as though intermediate term, the buyers are back in control. We're above that rising 5-day moving average, and when it breaks this symmetrical triangle, then it's probably going to go in the direction of that break, and that's what's looking most likely for it. Anyways, that's it, everybody. I see there's a couple other questions, but I'm done for the day. Everybody, enjoy your weekend, and thanks for tuning in.